Nothing changes my overall macro hypothesis that we're in a debt-based collapse, as we've always said. And they need to actually try flush some money into debt so that maybe they can scratch out a rate cut of some sort. But it won't be as well received in a demand-destroying event because a lot of the money still wants gold more this time than previous. Japan, Hong Kong, China, this is very important stuff. Everyone's forgetting that these are massive economies and they're going to probably be the bigger, better survivor out of the collapse of the West. And a lot of the flight capital will go from West to East, as has the gold before it, which again, why I reassert I'm a precious metals bull. And I think it's just being moved by location.
Gold doesn't move like stocks. While equities can rip higher or crash in a day, gold tends to follow slower, more structural trends. That's what the historical cycles tell us. And right now, we're at a point where caution might be more valuable than conviction. Analyst and trader FrancisHunt points to the recent surge from $2,000 to $3,500. That move was strong, possibly too strong. It overshot his initial targets, mainly due to geopolitical tailwinds. But that kind of spike rarely sustains itself. Hunt thinks we've likely seen the local top, and a pullback to $3,000, or even below, isn't out of the question. Zooming out, this isn't the first time gold has experienced sharp reversals. From 1968 to 1980, gold posted massive gains. Then it lost nearly 2/3 of its value by 2000. The 2000 to 2012 bull run saw another wave of strength before collapsing again, with its value cut nearly in half between 2011 and 2015. A new uptrend began in 2016, but history reminds us that even in bull markets, corrections are factual and painful. Currently, Hunt says the momentum has stalled. That doesn't mean gold's long-term story is over, but if you're a short-term trader, especially one using leverage, this is a moment to reassess. Upside is limited for now, and a third leg down could be forming. If a new regulation, geopolitical shift, or gold-specific shock were to hit the market, the correction could deepen. Technically, gold is consolidating around $3,300 as we head into the weekend. That's a holding pattern. No breakout, no breakdown. Meanwhile, Fed Chair Jerome Powell is keeping the markets in suspense. No decision yet on a September rate cut, and he's already flagged downside risks to the labor market. For gold, uncertainty is usually bullish. Lower rates, fiscal stress, and central bank intervention all strengthen its case. But in the short term, Hunt is clear. Don't assume gold keeps climbing just because it has. Tighten stops. Be patient. The macro tailwinds are still there, but the market may need to breathe first. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Go and have a look at 2011 and see how the M2 was going up, but you actually went from 1927 all the way down and languished for ages. So that's why I want to warn against just direct correlation. Where was the money going? It wasn't all going into gold, because you wouldn't have gone from 1927 in 2011 all the way down to 1,047 if the money was going into gold. So these notions that you can always use something as an indicator, we tend to see the things we want to see. The first thing that I see on that chart is an incredibly strong green candle move since the 2000 break. That is almost straight line up. And then, so it is a cautionary, different. I took something totally different. Look at that 2000 move that broke there. Go 2024, April, a little bit to the right. You've literally gone straight up. And now you're getting selling wicks on 3 candles. Look at that structure. That candlestick analysis is rejection. The one candle got 50% rejected. You got a spinning star doji and you're sitting on a shooting star. That's candlestick analysis on a big time frame, and it's very useful directionally. So you've had an absolutely violent move when you're on the bigger time frames. If you look from the 2000, it's almost near vertical. There's always a gradient. Obviously, time moves on, but it's been an incredibly powerful move. So you could pull back, as Eric said, to 3 grand, maybe a bit below. We've actually started to speculate draw, and we have some downside targets. But the only concern that I will add is that the first setup in a new trend has the potential for overperformance. So even if you get a geometrically induced target, it's a bit like a head and shoulders. You get a target, but it can be, in certain instances, you can get overperformance. I don't think this is a cyclical top. I'm calling a localized potential high at the 3.5. And nothing changes my overall macro hypothesis that we're in a debt-based collapse, as we've always said, and they need to actually try flush some money into debt so that maybe they can scratch out a rate cut of some sort. But it won't be as well received in a demand-destroying event because a lot of the money still wants gold more this time than previous. By saying the 40-year bond bull market turned in 2020, we've already staked our colors out there. However, in that journey, there isn't that straight line up. And when you're on the longer time frames and you looked at that 2000 move, that was pretty simple stuff. And you made 3,500. We called for a 50% move. The Trump tariff tantrum actually popped you an extra $500 out of nowhere. It took us a year to go from 2,000 to 3,000, which was our targeted call. And then you started to come off. And then you got this geopolitical event that gave an absolute melt-up moment of 4 quick candles that took you up $500. So we took a year and a bit to do the 1,000, and then you got bolted on this 500 that was entirely geopolitical and was a major flight of money out. And that tends to be quite exhaustive. So you could have a localized high for a while. That doesn't mean we're going back to 2,000 at all. In fact, I'd be a huge buyer if it was. But the circumstances of the environment of just one way up for people who've been leverage trading this could be very, very different. And we were the fanboys of this being a breakout ourselves, not a week ago, sitting in London. And I've now had a rethink, and I've now looked at more things, and I'm flipping my view that leverage long should watch the hell out and should preferably have very tight stops and real good reasons. And I'm not in that camp right now. Let's go back. So I actually have already got an inverted draw, which does provide a target on it. Let me just get it back to gold, away from the gold-silver ratio. And by the way, also on the gold-silver ratio, just while we were here, because we said some things, this typical area has been resistance, this orange area, which I've now done in pink. It's typically where it's been resistance. You broke out there, you might find a degree of support. You can see where I've highlighted it a number of times. This is a very dense area for the gold-silver ratio to work through. That's why it's a big significant moment. If we come out the bottom side, we run that and the 65. Then I'm all in on, and that typically comes in a QE type moment, poster drama, where they're unhinged. They went unhinged after CV19 on the print. That's when you had your 2021 high. It came out of that 2020, the response to March 2020, which actually started first with a disinflationary problem at the back end of 19. So that's how it works. You have a repo market crisis. Quick, bring on the special health interventions. Boom, health interventions and the fiat blowout. Then you got your 2021 high. So bad leads to good. But the point about timing is I want to show you two things, actually, to answer your question. Where's the support on gold? I also want to, just before I do that, so that I don't forget, show that on silver, because you should be able to do technical analysis on everything. There was a little bit of a reversal here with a neckline. And typically after target runs, you can see the blue line through here, you get a break. That target is up there. You've got a shooting star candle, not massive. That means a candle without, let me just hide some of the lines because we do so much analysis, can look messy. But it's a doji shooting star candle after making that target, which again, if I turn it on, the dotted purple line was just made. So you've made something technical that says, listen, don't be wading in leverage long. It could be small and it dips back a little bit. And this is a bit of a nothing, and we carry on, and the M2 keeps pumping, as Eric suggested might. And then we'll be buying long again, but gold and precious metals just sit back a little bit, or it could be something larger. And I mentioned the seasonality and various other things. What I love about Eric's viewpoint is that he has a Far Eastern viewpoint, and I think there's so much to that. And I had one observation, that when the dollar was really weak, that's the Taiwan dollar, the dollar was super weak, but the Hong Kong dollar trades in a controlled range. And so it's like both, it's not a peg, it's a floor and a ceiling to correctly determine it. And whilst the dollar was spilling, the Hong Kong dollar went really violently from the one end up. So this is USD Hong Kong dollar. So actually what should have been happening is that the Hong Kong dollar should have been sitting along the bottom like it did here. because the dollar was so damn weak. But what actually was going on is that this Hong Kong is more and more weaker than the dollar at the time that the dollar was really weak. So I was questioning, and I would expect someone with the news like Eric will pick it up long before I do. And that was fascinating, that Macau arrest. I didn't know that. And I love to hear that kind of news because I'm thirsty for Far Eastern news. Japan, Hong Kong, China. This is very important stuff. Everyone's forgetting that these are massive economies and they're going to probably be the bigger, better survivor out of the collapse of the West. And a lot of the flight capital will go from West to East, as has the gold before it, which again, why I reassert I'm a precious metals bull, and I think it's just being moved by location.
FrancisHunt points to growing currency instability in Asia, particularly in the Hong Kong dollar. As part of a broader trend, capital is moving east. The structural cracks forming in Western economies are becoming more visible, and precious metals are following the flow of wealth. Retail investors are re-entering the gold market in a significant way. According to the World Gold Council's Q2 Gold Demand Trends Report, total gold demand, including over-the-counter trades, reached 1,249 tons between April and June. That's a 3% jump from the same period in 2024, despite record-high prices. This isn't just ETF flows or central bank buying, it's broad-based. Retail, institutional, and sovereign players are all adding to positions. Evidence that the market sees continued stress ahead. Silver, meanwhile, is slowing down. After hitting key technical targets, it's showing signs of exhaustion. A reversal pattern is forming, which could mean a short-term pullback. Hunt doesn't see this as a trend break, just a pause. Traders should be careful not to chase the move without confirmation. Let's get back to the interview.
If we just show you this, Danny, and everyone was very benign round about this time on gold, when we just had a technical break of 2000. We'd had since 2021 a lot of failed attempts. So let's just remind everybody on the broadening structure. So this is technical analysis a la the market sniper. And this was a continuation pattern, but it was a lengthy one and it was a ball breaker. Because you had that 2021 run, you had a down leg. You had an attempt here, it got beaten back, you had a down leg. You had an attempt here, which tried a couple of times in a virtuous period, and you had a down leg that still took you to 1800. Once, twice, three times, and then we said we said this particular winding up structure that was sitting and supporting on 2000 after the fourth break, which was the key break for us, was going to be your golden opportunity for a target, and we spoke 2,900, 3,000 back then, and that was the target. It came from this flagpole that's off there, and that goes all the way up to there, and there was the 3,000 level. So that was our call for the target, and we repeated it. This is now a year-old clip, November 24. My apologies, April 24, and we're already, a year plus on that. That break began, and we were having a pre-chat now. Eric was saying, you don't get things going straight up. This was about as good as you get for almost straight up if you look at it. Very low vol, couple of winding ups on the way, and then you did your 2.9, you ran your 3K, and then you started what we typically expect, a progress decay, a little bit of slam back. But what happened around April 1 year later? Something unique. We had peak Trump tariff tantrum. This is when he was attacking China, Europe. Forget this recent European deal. We can talk if you want to about that.
The Liberation Day.
Yes, that's right. He was doing all of that. What happened? A prediction we had made in September 22 when Truss and Kwarteng were thrown under the bus and the pound collapsed and their bond market collapsed. We said that moment for the debt markets is coming for America. Trump went peak tariff tantrum. The bonds rate spiked. The valuations down, and instead of the dollar going up on those interest rate climbs, the dollar collapsed. And that's where then certain people said, well, it was the Japanese, the Chinese, somebody else did this to them. In actual fact, it was later shown Americans in America were the biggest sellers of A, the treasuries, which caused the rate run, B, dollars, and moving it elsewhere. But let's ignore who got scapegoated. That led to what is almost a turbocharged blow-off spike there, the Trump tariff tantrum of April, that gave us a baby's breath only at 3.5, We traded 3.5 for a second. So our targets of 293K were good. We started to sell off. Then an event intervened and gave us an exhaustive throw up. Okay, initially when I was looking at this pattern, now I need to drop time frames. I was like continuation, bull bias, debt is a busted flush, etc., etc. But then I'm also listening, and I'm going to give you the social things. George Gammon's channel, what if they re-rate gold to 20K? Clive Thompson, $15,000 to be re-rated. Recently, Luke Broman, for example, all good analysts, but I'm not knocking anybody out, all good analysts, lauded in Zero Hedge for saying what we said in 2020, that there's reserve asset substitution away from debt into gold. This is it. Look how well he explains it. This is all coming out. So we're no longer fringe. We're mainstream, all our takes, opinion, and too many people are standing on my side of the boat. Then you listen to SLV, no borrowing, lease rates up on platinum and silver. One, it could be manufactured or it's true. If it's true, they're not going to let us win out without a fight. So that's a bit of fundamental and a bit of what I call sentiment indicator. Initially, we said this was a bit ascending for us. We discussed this in the community, but if it breaks, we're going on an upside. It broke. We were taking high fives and being, the usual. Market will always humble you and make you reconsider. But I was doing it a bit for entertainment purposes. I was walking around London, good triggering event, bit too cocky and confident. The momentum in terms of the way we got rejected strikes me as exhaustive. Don't forget, you had a real reason that everyone panicked out of debt, and you got a real exhaustive sell-off there that smashed you down there. That we typically call a slap in the face. And as I say, it mimics the technicals of the bond market, which I can show you if you're interested to see. This is a very similar setup. This momentum to the downside, there's your exhaustive sell there. There's the second one. Typically, they should get less when you're doing a volatility squeeze. The calming is part of the price behavior. That's why we call it the Hunt volatility funnel. It's the funneling down of volatility. That was a major surge that looked single-minded, and we were cocky confident. That engulfed it and is hard down. Now we have one pattern that is the hardest to spot, and we usually get it wrong, but we've learned to pivot quicker. And this is the bit where everyone hates you for changing your view or your take. And the truth of the matter is, it's a sign of a good technical analyst, but you'll not be loved for it. This is a slap in the face event that was driven by what I just described, the Trump tariff tantrums. When we had already made the 3K targets and we're in a progress decay phase, we got this massive blow off. Now, too much of what we talk about is mainstream, and this is in fact the squeeze. What you could get next, a weak rally, for example. It's been very dead at those low levels. This is not much price action. Given how hard you came down, if you were to be bouncing, you should already be bouncing. It's not happening. A weak rally sets up the flag, and we get our third impulse for a downside move. That ties in with a demand-destroying event where everything gets sold. You could also have news that's gold-specific. All gold holders need to register with a registered vaulting service, which will be on the blockchain for your safety, regular audits. Who knows? There could be a narrative that drives it. That could be gold-specific, or we don't even need that. It could be war breaks out. The other thing that's happened that I called, but I'd stopped watching because it was almost a fait accompli, was the gold to oil ratio. We said, go. Everybody thinks all commodities are going to run. We said energy complex is not going to be good. We're actually mildly bearish oil, but very bullish gold. Now, we said, draw the inverted head and shoulders here. Here you go on gold versus oil. So that's gold divided by oil, weekly chart. We said you should make these targets here, dual targets up top there. This was, don't forget, you had a low when oil was 129 and gold still hadn't broken out the 2K. That was 14 barrels you got for 1 ounce of gold. The neckline was 28. We said you should be making 52. I missed that. It actually had already run and happened. This is the thing. We get so excited and we're in the bull market. We're all watching the 15-minute chart and the 5-minute chart in the ever pumpamentals of the run-up. And key targets have been dropping that were set. And for people that think, technical analysis, that doesn't work. Okay, it's done that. That head and shoulders is part of the reason we called the previous. We said oil to trade single digits, one of our biggest known calls that we're famous for. On a stage, we've got 2 recordings of it. we said at $67, we see a single-digit oil. People are not pricing it suitably. It hasn't been there for 35 years. I know I sound insane. It could happen. There's that head and shoulders that did it. It went to infinite. If you did that trade that we called the same trade, long gold, short oil, you had the 21 pump high of gold and you saw the collapse to zero, never traded at zero before, which was obscene. Okay, it was CV19. It was kind of lucky, but that was the most extreme right we've ever been. And that target is now made. It tells me pullback season. The bond market, our other most famous call, is always the difficult. September of 2020 looks exactly like that gold chart. What happens is the money chases in. The money keeps chasing in on the ascending part here because they say, oh, it's cheap, quick. The late bulls are coming in. The late bulls are coming in. Each bounce, late bulls. Then you try run and bang, you get spanked.
After a vertical move like gold's recent run, the shift to hesitation isn't weakness, it's a test of conviction, discipline, and memory. Those who've studied past cycles know the script: bursts of strength, then air pockets. Signals now point to a recalibration phase. Liquidity is still flowing into metals, especially gold, but it's doing so in waves, not surges. Technical setups are cooling, and momentum is fading just enough to shake out late entries. However, when capital begins to reposition across regions and monetary policy starts to flirt with more intervention, the setup becomes less about if and more about when. If global capital is repositioning towards safety, will metals retake the lead, or will they need one more flush before the reset truly begins? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.